A mutual fund is a portfolio of stocks, bonds, or other securities that are purchased by collecting money from a group of investors. Let us imagine that we are studying in a college and we are a group of 5 friends. Now, during lunchtime, all 5 of us go to the canteen and want to eat a variety of things. But the problem is that each of us only have rupees 50 in our pocket. And let's assume that each dish costs rupees 50. Now, in order to taste a variety of dishes, all 5 of us decide to pool in our money and buy 5 different dishes. In that way, we get to taste a bit of all the 5 dishes and we only had to pay rupees 50 from our pocket. This is exactly how mutual funds work. An equity mutual fund collects money from people, pool it together, and then buy a variety of stocks which otherwise would have been difficult for an individual investor to buy. For example, MRF has the highest price in the Indian market as of now, which is rupees 1,27,000. Now, it becomes very difficult for an individual investor to buy shares of MRF. But by pooling money from various investors, it becomes easier for a mutual fund to buy shares of MRF and give you a percentage ownership in it. So, if a mutual fund has collected rupees 1,27,000 from 10 investors equally and buys one share of MRF from it, then you will have 10% of ownership of only a single share in the market. Now, this gives us a very important advantage of mutual funds, which is diversification. With the help of mutual funds, we can become part owners in different stocks, which wouldn't have been possible if we would have less money and would want to buy more stocks individually. Remember, even after all of our studies on a single stock, it is very difficult to be 100% sure that the stock will give us superior returns in the future. Therefore, diversifying our money in various stocks helps us to reduce that element of risk, and mutual funds help us achieve exactly that. Also, we need to know that since diversification reduces risk, it also has an effect on our returns. The more the risk an investment exhibits, the more return is required by an investor from that investment. Since fixed deposits exhibit little to no risk, it gives lesser return. But as the risk keeps getting higher from fixed deposits to corporate bonds and to equities, the return required by an investor also keeps getting higher. Why is the risk highest in equities? Because equities represent ownership in a company, and the owner is the one who takes the highest risk in any company. With this overview, we hope we helped you understand a bit about mutual funds, and we'll be coming up with more such stuff about fund investing only on Finquisitive. Thank you so much for watching.